Can everybody hear me okay?
There we go.
Good afternoon. Hopefully you're still awake after the presentation at the board meeting. We're going to give you a little bit more details on risk-based capital proposal that the board just voted to put out for a 90-day comment period today at the board meeting. The goal will be for me to walk you through some of the key changes we made in this proposal with the slides here that we have that we'll go through, and then take questions as John had indicated. Go to the first slide. Just to kind of reiterate what our goals for this proposal were, in addition to being faithful to the Act's requirement to have a meaningful, relevant, comparable risk-based requirement and the recommendations of GAO and IG, we also have some really good public policy reasons for modernizing and updating our risk-based capital framework. Goals included making sure that larger, more complex frames have sufficient capital relative to their risk, and that they stay that way going into the future as they grow and expand into new products and services. We also wanted to incorporate a more modern approach to calculating risk-based capital. Our current rule does it unlike anyone else in the international or U.S. space, and so we wanted to make that calculation more comparable to other financial institutions. And we certainly want to make sure that going forward, credit unions continue to be able to serve as financial intermediaries, provide credit and other products to consumers that they serve, even during times of stress, without having to rely on government assistance or intervention. So those are some of the key goals that we hope to achieve with this. One of the key changes we made from this proposal, from the original proposal and from the current rule, is redefining what is considered a complex credit union. The Federal Credit Act requires the board to design a risk-based requirement for credit unions that the board defines as complex based on the portfolios of assets and liabilities. What we did is we did an extensive analysis of portfolios of assets and liabilities. I think there's 15 different products and services we looked at to make up that definition, and came up with a proxy for that definition of 100 million in assets. The current definition exempts only 50 million in assets or below credit unions. The revised definition in this proposal would only apply to credit unions that are greater than 100 million in assets. That would cover 90% of the assets in the trading system, but exempt almost 80% of all credit unions from the regulatory burden associated with this proposal. The definition is based on an analysis of assets and liabilities. Every credit union that's over 100 million has at least one complex activity that they're doing, and most of them, 87%, I think, have 4 or more. So it's a very good proxy, and it achieves some benefits, as Steve had indicated at the board table today, of simplifying the framework a little bit and making it easier for credit unions to understand if they are or not subject to this rule, as opposed to having to analyze the whole 15 products. And it also makes it easier for them to plan as they go forward. They'll know what the bright line is, as opposed to having to deal with a specific list. And finally, it also hopefully avoids some unintended consequences of a specific checklist of activities, where if they're thinking about offering 1 or 2, but they're worried about complying with this rule, then it might disincentivize them to do that activity. We don't want that to be the case. Having said that, this is an area where the board is specifically requesting comment in the preamble. So when you read about this in the preamble, you'll see at the end that we specifically solicit comment on this approach and alternatives. Go to the next slide. Thank you. Another change we made from the current proposal to the original proposal, from the original proposal to this new proposal, is reducing the threshold for well-capitalized. The original proposal used a 10.5% threshold that the risk-based capital ratio for an individual credit union had to exceed to be considered well-capitalized. That was based on the other banking agencies' provision that required both for the total capital ratio an 8% level of risk-based capital plus a 2.5% conservation buffer, capital conservation buffer. That's how we arrived at 10.5% in the original proposal. With this proposal, based on stakeholder input and additional analysis that staff did, we concluded that in fact, no, it made more sense to go to the 10% total capital requirement that the other banking agencies use for their risk-based capital ratio. That's better aligns the consequences for not being well capitalized with what a bank would be subject to under the other banking agencies' rules. So we'll segue a little bit into deconstructing actual new risk-based capital ratio calculations. We'll focus on elements of the numerator here on this slide. On the left on the screen, you can see elements that are added to the numerator that count as capital under this proposal. The first ones that come up on the list here, that list is what is already included in the statutory definition of net worth for purposes of calculating the net worth ratio. So we continue to include those items in the definition of capital for the risk-based capital ratio numerator, but we've added two additional items, equity acquired in merger, which GAAP would consider as equity available to absorb losses, and the allowance for loan and lease losses account is included in this proposal, as it was in the original proposal. The difference, though, between this proposal and the original proposal is specific in this context related to the allowance for loan and lease losses is we've uncapped its inclusion in this proposal. Basel and the other banking agencies have long capped, and in fact our current rule caps inclusion of the allowance for loan and lease losses at 1.25%. In our case, I think of loans in the current rule. In Basel, I think it's of risk-weighted assets, if I'm not mistaken. 1.5 of loans in our current rule. So caps exist in our current rule. They exist in the banking agencies and Basel standards. We've uncapped it with this proposal. We think that makes sense for a couple of reasons. Number one, as some commenters pointed out, there's potential pending changes to the accounting rules as it relates to how credit unions have to reserve for the allowance for loan and lease losses account. That could create some problems if that goes into place, and allowance for loan and lease loss accounts need to grow to be in compliance with that accounting requirement. This wouldn't therefore create a problem with that. The second reason we think it makes sense is it is in fact available to absorb losses, albeit specific to loan losses, not other types of losses, but it is a form of capital available to absorb losses. And thirdly, it functions better this way under different economic cycles. As credit unions go through an economic downturn and naturally delinquency and loan losses rise, their accounting that goes with that to increase the reserves would cause those levels to rise to follow GAAP. And then more of that could then be excluded with the cap. So we thought this lifting the cap would allow this rule to better perform under different economic cycles. So that's what goes into the numerator in terms of an addition. There are some deductions that are in this proposal. All of the deductions in this proposal are the same as from the original proposal. We deduct, like the banking agencies do, specific identified losses that weren't already accounted for. We also deduct goodwill and other intangible assets, like Basel and the other banking agencies do. I'll get to a little nuance on that. The one unique aspect, though, for credit unions in this proposal that doesn't really exist in Basel or banks because it's not relevant is how we treat the share insurance fund capitalization deposit. It's a long-standing policy reflected in Congress's treatment for the leverage ratio or the net worth ratio. In the 1997 Treasury study, as well as in agency policy, that the share insurance fund deposit is not available for an individual credit union to absorb losses. That's not how it works. It's analogous to goodwill and intangible assets. In that sense, it's not something that a credit union can use to absorb losses. And in fact, it's not available when we have to liquidate a credit union. It's equity of the share insurance fund, which is the other concern with that. Us counting it as equity in our insurance fund and credit unions continue to count it as an asset on their books double counts the total protection in the system. And so that's why we make the deduction in the original proposal, and we continue that in this proposal. The asterisk on goodwill and other intangible assets, there's one change we made from the original proposal with this proposal. For goodwill and other intangible assets related to an NCUA-assisted supervisory merger, the deduction won't occur for those elements until January of 2025. So other goodwill and intangible assets would start to be deducted if this rule went into effect on January of 2019. But the supervisory merger portion would not be deducted until January of 2025. So we gave those credits a much longer phase-out period, which should make it end up being at the point where it's not material to them anyways, under the accounting rules. So that's the key changes for the numerator of the calculation for the risk-based capital ratio. And we'll go next to start to deconstruct the denominator, what goes into the risk-weighted assets that serve as the denominator of the risk-based capital ratio. The first and biggest change relates to investments, and that's as a result of our decision to extract, in this proposal, consideration of interest rate risk in the way we approach categorizing risk assets and weighting them. So the biggest place where we currently, in the current rule as well in the original proposal, consider interest rate risk is in how we weight investments, and so that necessitated significant changes in this proposal. So what we've done is we've calibrated the current, this new proposal's risk weight categories and weights to the other banking agency standards. I think all of us could agree that an investment that you or I buy, or a bank buys, or a credit union buys, are going to perform on a credit basis the same regardless of who holds it. So we saw no meaningful reason to vary from what the other banking agencies do on investments, except for, of course, when there are investments that are specific to credit unions, don't exist in the other banking agencies construct, like credit union service organization investments and corporate capital investments, like perpetual corporate capital and non-perpetual corporate capital, I think is the term for it, right, Rick? We are, while we're talking about investments in relation to interest rate risk, that's another section in the preamble where we specifically ask for commenters to give us advanced comments on how we might think about, as we continue to work on interest rate risk and a different approach to interest rate risk, what other alternatives might we consider. In the original proposal of January 2014, we separately risk weight consumer loans, but we defined all consumer loans in one risk category and weighted them at 75% risk weight. And we used the 75% risk weight, which is lower than what the other banking agencies risk weight loans at 100%. We use that lower risk weight because, by and large, credit union performance in consumer lending in terms of delinquency and loan losses is better than banks. And we referenced off of the European Union's use of a 75% risk weight for consumer loans. So there was another cohort out there that we could look to. Interestingly enough, many of the commenters pointed out to us during the comment period that secured consumer loans were less risky because of the presence of collateral, typically by definition, and by performance statistics when you look at the different performance statistics between secured and unsecured consumer loans. There is a distinction. So this proposal creates a more granular structure for consumer loans. So we separate consumer into secured, unsecured, or fully share secured. Fully share secured would get a low risk weight of 20%. Secured consumer loans would continue to get the 75% risk weight that we had in the original proposal, but unsecured would receive 100% risk weight. The other big change we made, it isn't just specific to consumer loans, it actually applies to all loans. As Mr. Metzger pointed out at the board table in particular today, we chose to redefine what is a current loan as any loan that is less than 90 days past due. We raised that from the original proposal of 60 days. So that went from 60 in the original proposal to 90 days past due or less in this proposal. That matches up with how the other banking agencies define current or not delinquent. Another area where we made fairly substantive changes that I think credit unions will appreciate, and it makes sense for us to have done, is we differentiated between the statutory definition of a member business loan and what's considered a commercial loan for risk weighting purposes. We can't change how the statute defines a member business loan for purposes of evaluating and measuring against the statutory cap on member business loans. That will remain the same, of course. But for purposes of risk weightings, we could take a more modern approach to what really is a commercial purpose loan, what's the actual risk involved with those types of loans, and better align that with how the banking agencies risk weight those types of loans and the actual risk of those loans. And so what you can see up here are the key distinctions we're able to make as a result of this change. 1 to 4 family non-owner occupied residential real estate loans, while still an MBL for purposes of the cap, would not be considered a commercial loan under this proposal. That's a big change from the original proposal, as well as the current risk-based rules that credits operate under. Under our proposal, for this version, it would be weighted as a residential real estate loan. Another change we made in the definition of commercial loans is a vehicle that is generally manufactured for personal use but not used for fare collection or purposes or part of a fleet would receive treatment as a secured consumer loan, not as a commercial loan. You might think of, for example, a farmer who buys a pickup truck and uses it as part of the business of running a farm. That would get a secured consumer loan risk weight treatment, even though it's part of running the business. And then the other change that this would involve is, and actually commenters pointed this out, take the identical loan, same collateral, same business purpose. One is $50,000 plus a $50,500 balance, and one is $49,500 balance. Under the definition for purposes of the statutory cap, the loan over $50,000 is considered an MBL, but the loan just under it is not, and that really doesn't reflect the risk. And so all loans that meet the new definition of commercial loans for risk weighting PCA purposes would be considered a commercial loan and risk weighted accordingly. We would not have the $50,000 exemption. We still have that, of course, for purposes of the MBL cap. A couple of other nuances that we worked in to this proposal relate to either portions of a commercial loan that are either backed by a contractual compensating balance held on deposit at the credit union or backed by a government guarantee, and not just the federal government. I think it's broader than that. It includes state, local. So any portion of a commercial loan that's backed by a government guarantee, that portion is risk weighted lower, and it's also not counted against the concentration threshold. It's the same is true of the compensating balance portion, which leads me, I think, to the next slide, if I'm not mistaken. Another adjustment we made, a calibration in this proposal from the original proposal and from the current rule, is to simplify the concentration risk framework. In the current rule and in the original proposal, we had two breakpoints for real estate loans and commercial loans as it relates to concentration risk. We've simplified that to one dividing line for each and calibrated it to really just pick up the outliers. And so under this proposal, there's three areas where that concentration dimension comes into play. For first lien residential loans, any first lien residential loans that exceed 35% of total assets, that portion would start to be risk weighted at 75% from the base rate of 50%. So the first 35% of assets would get the base rate of 50% risk weight, and then the portion above that would be a 75% risk weight. It ends up in a blended rate. So the whole portfolio doesn't shift from 50 to 75, it's a blended rate. The same is true for junior lien residential real estate loans. The breakpoint there is 20% of assets. The base rate is 100% risk weight. The concentration threshold rate is 150, again blended. There are only two credits that actually exceed both thresholds. And you can see there's 149 that exceed the first lien and 67 that exceed the the juniors. And then finally, commercial loans at 50% of assets would receive 150% risk weight. Commercial loans below 150% receive 100% risk weight. So that's how, again, that also is blended. So that's how that concentration risk framework works. We tried to better calibrate it to outliers, harmonize how the risk weightings work, and simplify the framework. I would note, of course, while we're discussing concentration risk, it is a material risk. It's something GAO and IG have specifically indicated that we needed to address. It's part of the current rule, so it's not a new construct. And we've had several material losses resulting from concentrations in member business loans and in real estate loans, including junior lien loans. Move on to the next. So those are sort of the key changes to what go into the numerator and what go into the denominator, how the risk assets are being weighted. The purpose of this slide, this pie chart, is to really show how that compare and contrast our risk weighting approach to the other banking agencies' risk weighting approaches. So that's where the color color codes come into play. For all of the risk assets of complex credit unions, 78% of them would receive comparable risk weights, very similar risk weighting to what the other banking agencies provide. So 78% of all complex credit assets would receive the risk weights of other banking agencies. About 19% of assets in complex credit secured consumer loans make up 19% of the total assets in complex credit unions. We receive a favorable risk weighting of 75% versus 100 in the banking system. Only, I think this is about the red slices, so what's left over? 3%, thanks for doing the math for me. 3%, the red slice of the pie, would get a slightly more conservative risk weight. Most of those really relate to the concentration risk dimensions that we discussed. And then this tiny, tiny sliver here that's gray is just not directly comparable. That's really QSO investments in corporate capital. A very, very small portion of the total balance sheet of complex credit. So you can see we're very comparable and or favorable for credit unions in this proposal. This is just another way of looking at the same data, and this provides you the actual risk weight. So consumer loans secured at 75 versus the other banking agencies 100. So that's just really more for information. So you can see the actual risk weights. I think my staff put it in there in case I forgot the risk weights. Handy reference. What this slide's doing is giving you some context around how the current net worth ratio standard that's in the statute relates to actual capital levels in credit unions today, and how the proposed risk-based capital ratio, both the proposed standard and the estimated result for credit unions for complex credit will relate. And so currently, the statute requires a 7% level of for the net worth ratio to be well capitalized, 7% or greater. Credit unions, on average, complex credit unions on average are at about 10.7% net worth. So they have about 50% over the minimum requirement to be well capitalized. Under this proposal for the risk-based capital ratio, we propose a definition for well capitalized of 10% for the risk-based capital ratio, and estimate on average complex credit would have a 19.3%, or almost double the level of what it would take to be well capitalized. So by and large, this reflects the credit system is very well capitalized relative to its risk. Of course, there's some outliers that we are worried about, and so if we go to the next slide. What we do is we take the distribution of the proposed risk-based capital ratio and the estimates that we resulted in, we catalog them across a range of risk-based capital ratios. So what you see here down on the left, in the shaded area, is credits that would be less than 8, so 0 to 8%, and 8 to 10%, so less than 10. There's 27 total that would have a risk-based capital ratio of less than 10%. All of the rest would have a ratio of more than 10%, average again being 19.3 we talked about on the other slide. We go in 1% increments along the bottom here until you get to 20%. And then you can see there's a huge chunk of credits that are even over 20%. This is 20 to 30%, and this is greater than 30%. And so most credit unions are very well capitalized relative to this proposed standard, but there are some that we need to focus on, and that's what we're trying to address with this rule. And then another way to think about this, what we're trying to show on this slide is, and let's back up a second. This slide is showing, based on our estimate of each individual credit union's risk-based capital ratio, whether they would meet the well standard or not. Do they actually have the capital relative to the calculation? What this next slide is showing is, we're not actually looking at how much capital they have. We're not looking at that. What we're looking at here is which standard, the current net worth ratio in the statute or the proposed risk-based ratio, would require them to hold more capital. It's not saying that they don't actually have the capital. They may already, right? All it is saying is which one would require them to hold more, right? Which is the binding constraint. And of the 1,455 complex credit unions, the binding constraint is still the leverage ratio. For 1,396 of them, it's only the binding constraint for 59 complex credits, where they're right of this line. The line is not at 7%, which is the statutory definition for the well-capitalized standard for the net worth ratio. It's at 7.5%. The reason for that is we have to make an adjustment for the fact that our broader definition of capital, what elements of the balance sheet count as capital under the new proposal, it's broader than what is allowed for net worth in the net worth ratio calculation. And that benefits credit unions on average about 50 basis points. In fact, many benefit by over 100 basis points. And so that's why you see the line set here at about 7.5%, not 7. And while it may not seem like a many credit unions, 59, those 59 credits hold almost 40 billion in assets. And the 27 that have a ratio of less than 10% have over 13 billion in assets. So relative to $11 billion share insurance fund, this is still significant. Just talk a little bit about the implementation time period that the board envisions with this proposal. We just acted on the revised proposal for a 90-day comment period here in January of 2015. Hopefully, aspirationally, we would be potentially seeing a final rule somewhere end of 2015, early 2016. We haven't set any timetables. I'm just kind of giving that for context. But the goal would be, assuming we get a final rule somewhere in that range, to have the call report changes implemented by the end of 2017, leading into the start of 2018, so that would credit unions and our staff would have a year to see the new results and the new data that goes with this rule for a year leading up to the effective date of January 2019. So this proposal would more than double the implementation period for the effective date than was in the original proposal. And then finally, I would just simply note again that the one further out phase-in extended implementation aspect is for these goodwill and other intangible assets associated with supervisory merger. Those don't get phased out until January of 2025. With that, I guess I'm ready to take questions.
Okay.
I think John's going to...
Yeah. Yeah, so just in case people need to know, it's about 20 after 1. So, in case you've got other appointments or anything, just want you to be mindful of time. So, Amanda has a mic, and Mary, we'll start with you.
So thank you for the briefing, Larry. Larry, can you talk a little bit more about the provision regarding additional minimum capital?
Additional minimum. Are you talking about the IMCR?
Exactly, the authority of the agents.
So we had in the original proposal this discussion of what we called an individual minimum capital requirement, or IMCR. And that was really to elaborate on the process we would go through when we would decide that despite the fact that a credit might comply with the minimum regulatory requirements, we might conclude that their risk was still greater than their capital, or the capital was insufficient relative to their risk, and what process we would go through. We've now removed that from this proposal, but simply note that we still have our statutory authority to reclassify a credit union one category down. That can only be done by the NCUA board. That's very clear in the statute. So an individual examiner can't do that. Certainly, the identification of the need for that would start at the field level, but it would have to work its way all the way up to the board for the board to act on that, for that to become effective. So that directly affects a credit union's PCA category. And that provision applies to both the leverage ratio and whatever risk-based ratio we have. We also have our range of other authorities. Traditional unsafe and unsound condition and practices authorities. So let's say a credit union had an inordinate level of risk relative to its capital, and it wasn't being picked up by the ratios that are in the minimum regulatory requirements. We would work with that credit like we do now through the exam process to identify that issue and to try to come to some resolution of that. And ultimately, if we had to, we could use our standing existing enforcement authorities to deal with that. Now, generally what that might mean is, let's say they're doing commercial lending, and they're doing a lot of it, but they're not doing it very well, so the risk that they have on their their books is much higher than normal. So it's not really being captured in this framework. We would work with that credit union to improve their processes, first of all, certainly. And secondly, we would either suggest perhaps limiting some of that risk, reducing that risk, raising some more capital to offset it, or some combination of the two. But it would be the credit union's choice which strategy to pick. We would just be clear, you need to do something to rectify the situation. And ultimately, if they weren't, we could use our enforcement authority to make that happen.
Another question?
There's one other piece I wanted to mention. This proposal does add a new provision that says essentially all complex credits have to hold capital commensurate with all their risks. They have to have a process they go through in analyzing that, and they have to put it in writing. That's an existing explicit standard for the other banking agencies in their regulation, and it's an existing explicit supervisory standard for us. In fact, I quoted, I think, at the board table today from the letter to credit unions and from the examiner's guide where it says that. So what we wanted to have happen with that is it doesn't change anything. It doesn't change how we currently approach things, but we wanted to be clear with this proposal. A complex credit union can't just say, I'm good with the risk-based capital ratio, which is really only credit risk and some concentration risk in this proposal. Therefore, I don't have to worry about other risks. That is not true, and it was never intended to be true. And so that's what that provision is reminding, but it doesn't really change anything. We still have that existing supervisory authority and that existing standard now. We just want to be clear in the rule about it and explicit.
John?
Two quick questions. One, first, I wanted to ask about acquired equity, and if I understood you right, what would qualify as acquired equity is if a credit union acquires another credit union, it's that acquired credit union's share insurance deposit.
So I think the question is really, could we go back to the slide on the numerator? The equity acquired in a merger,
Yeah.
under generally accepted accounting principles, GAAP rules, when two entities combine, it's called combination accounting. They have to value the assets and liabilities, and those don't always match when they do that valuation. And so that could generate surplus equity as a result. And I am simplifying, keep in mind. But that's what that is that whatever that extra equity is in a merger, that's what this deals with. Did I get that right, Steve? Or did I miss that?
It's more the GAAP measure of the equity from the combination.
Right.
In their net worth calculation, we use the figure that is pre-acquisition retained earnings, which is a non-GAAP item that's included in the net worth ratio. And it can cause inconsistency between GAAP equity and regulatory equity. This focuses on GAAP equity.
So this would be the GAAP calculation for whatever that figure would be. The Congress did provide a fix for the retained earnings definition if it retained earnings of another credit union, but those aren't always the same as what Steve's saying. And so this is capturing what GAAP defines as equity.
I'm not sure I'll be able to clarify this as much because I was asking clarification for how you answered the end of Mary's question about, you say we already have existing authority that we require credit unions to, assess their capital on their risk anyway. Is that proposal only going to apply to complex, or are you going to put that for all credit unions? I haven't read the proposal, so I don't know how it's worded.
Right now, it's specific to complex credit unions.
Complex under the
Under the proposal.
even though your basis is it does apply to all credit unions,
All
but
credit
you're just sticking it in this regular.
Yes, because it's in the context of the risk-based capital.
That's why I thought it clear.
Yeah.
Next question.
Yeah, Larry, thanks for this briefing. One of the things our members are interested in is the extent to which their capital requirement may, in effect, have been increased because of the risk-based standard as opposed to the old 7% rule. And I believe that's probably the 59 credit unions where the RBC rules as opposed to the 7%. Did you guys figure how much, for those credit unions, how much additional capital they would need in order to remain well capitalized under this proposal?
So let me,
the total dollar amount.
Yeah, that's a great question, Bill. Thank you. Let's go back to the other slide. there's the 27 that would have to raise some capital to stay well capitalized, right? Well, in fact, it's not 27, it's 19, because 8 of these 27 already are below 7% for the net worth ratio. So they're already not well capitalized because of the existing statutory requirement. So it's really net of 19. That number is, I think, for them, that 19, if they only solve it through capital, right, not making some risk adjustment, is about 53 million, okay? Now those 19 are also included, we'll go to the next slide, in the 59 where this is governing, right? Yeah, so there's 40 net, right? But let's just do the total number, all right? So 59 includes the 19 we just talked about. So how do these 50, the 19 have to raise some capital, 50-some million, but in total this group, the incremental difference between the leverage ratio and the risk-based ratio for them is about 400 and some million, if I'm not mistaken. 430, I think. Okay, but I want to be clear, other than the 19, the other 40 already have it.
So you mentioned that the threshold for a complex institution is being raised under the new proposal from the 50 million to 100 million, and that you set the 100 million threshold based on different assets and liabilities and the activity in different credit unions. Can you talk a little bit about the analysis you did around that for that list that you came up with and what it looked like in $50 million credit unions versus 100 and 100 versus 250?
So I'm going to have to pull out some notes for that one. What I can say is, off the top of my head, the 100 million or greater all of them had at least one. 99% of them had multiple, and 87% had 4 or more. So that gives you a sense of what the 100 million and above looked like in terms of that mix of products and services we looked at, or assets and liabilities, another way of saying that. The group below 100 million, well, I think actually Steve's going to have to help me with that. I don't have that in my cheat sheet, but it was much lower. In fact,
Yeah,
I'm gonna.
I mean, that was always a concern we have, and that you do have credit unions between. Yes, certainly there are credit unions between 50 and 100 million that would have more complex activities than some that are over the 100 million threshold. But there was a significant difference in the percentage of that occurring. As we lay it out in kind of a graph form, the incidence of 87% having 4 or more is so much greater on that over 100 that it was a clear demarcation. And that was how we determined that, which is consistent with the process we used when we set it at 50 million before using the complexity index. So a lot of the same strategy was used in looking at it for this purpose.
It was a dramatic. I know we have some more figures on the group below 100 million in the preamble. I just can't a lot of keep track of with this. But it was a big drop in any that even had one, let alone the percentage that had multiple.
Another question? Right there.
Larry, I was counting and then I lost count. You mentioned consistency with other banking regulators, FDIC specifically, at least 10 times, maybe as many as 15 times. Seems to be a theme. And one of those cases had to do with the change in defining current versus delinquent loans. The 60 to 90 days, a welcome result. I think the credit union system has been arguing for that for a long time. But besides the fact that it makes NCUA consistent with FDIC, any other reason for changing the definition of a current loan?
I think that was the primary driver there. But thank you for your question on comparability, consistency. The Act does require us to be comparable. The Act has a couple of provisions. We need to be comparable, but we also have to take account of all material risks. So So comparable in the context of risk where the other banking agencies are taking account of it, and then we have to sort of come up with our own approaches for other risks that we think are material that need to be taken account of. So when it comes to credit risk, which is what this is, the delinquency, the current definition is dealing with, we didn't see a really good reason to not be comparable, to vary from that. The reason we have 60 now, this actually goes way back. You can go back 20 or 30 years on this discussion. It used to be that credit unions defined a delinquent loan, we use the term delinquent, different than how banks define past due. And it depends on when you start counting. Do you count from the day of the last payment, or do you count from the day that you missed the next payment? And so 60 days delinquent used to mean 90 days past due, so they were very similar. But a lot has evolved since then in terms of how you report to credit ratings agencies in terms of the status of a loan and the payment history, and so that isn't always the case anymore. And so we thought it made sense to align more on that. You could make a counter argument, though, that 60 is actually more prospective and reactive. So there's a debate on both sides, but in our case, comparability provision, not disadvantaging credit unions, that sort of thing, we went with 90 on this proposal.
One more question related to delinquency. With this change, I'm guessing that you've done the calculations for how that would affect overall system delinquency levels. So what, any numbers on how that changes aggregate delinquency levels?
Yeah, so one of the things that we're still thinking about is, will we change the delinquency ratio to be 90 days past due versus 60? So we haven't finalized that decision. Because there is some utility in seeing that number as an advanced signal of deterioration in the investment portfolio. So we're not risk weighting it that way, but we might still, and we haven't made a decision on that. Of course, this isn't a final rule either. So until we have a final rule, we won't make a final decision on how we would change the ratio that shows up on the FPR for delinquency. Oh, the other reason I would mention on the 90 days past due, it does align better with our TDR rule. The TDR rules is referenced off of 90 days past due. So that coheres this that to this as well. Thank you for that.
Another question?
I guess just a logical question. We'll get immediately on this one. So you could anticipate the 60 to 90 day rule possibly not waiting until an effective date of 2019 to have, because credit unions are going to really be interested in this, they said. So this is something that there may be an acceleration of looking how credit unions can report delinquencies past due, not necessarily waiting for this rule not only to be finalized, but to go into effect. These can be pulled apart. What are you thinking? Just anticipating possible things.
So I think the way I would respond to that is, whatever call report changes we're going to make because of this rule, there might be other call report changes we're going to make for other reasons, but just to improve the call report or what have you. But specific to this rule, whatever call report changes we're going to make, we're going to try to do in 2016 and 2017 to have them all ready come 2018, so that all the changes are in place, and now the FPR, the financial performance report, and the other things that that credits get from us will line up with this. So that would be one. If we're going to make that switch, we'll have made it by then.
But it won't be before then, I think, is the question credit unions will have, because this is a lot of other implications beyond just this reg.
Correct.
So for a lot more credit unions that will be been covered by this reg.
Correct.
That's why I'm just
Yeah.
at least raising the question we're going to get by the end of the day.
And I can't give you a specific timetable on that. Yeah, I was going to say there's a lot. Even making a change like that takes time. It's not insignificant. So.
Other questions?
Board Member Metzger mentioned that the implementation period of 3 years could actually be too lenient. Do you foresee a scenario where that could actually be pulled back and it could be an earlier implementation period?
I don't want to try to speculate on ultimately what the board will decide on that. So this proposal calls for a January 2019 implementation period. I do think that gives us ample time and creates ample time to get ready for the changes, but depending on what the final rule looks like, who knows?
Regarding the weights on consumer loans, I think in the initial proposal, they were all weighted at 75. which was across the board less than FDIC, which weighted them at 100. With the new proposal, you made a distinction between secured and unsecured, secured at 75 and unsecured at 100. What was the rationale for changing the weight on unsecured?
So the rationale, if we go back to no, I was actually going to suggest we go back to I didn't want to call it that, but the pie chart slide. Thank you. So just to give you a little, this is just for context, but the main rationale was commenters actually pointed out to us, based on the original proposal, you've put all consumer loans into one risk weight bucket. You weight them at 75%. The banking agency rated it at 100. But they said, isn't it true that a secured consumer loan is less risky than an unsecured? And on average, that's true. You have collateral with a secured consumer loan, you don't with an unsecured. And most of what makes up unsecured loans for credits are credit card loans, which tend to not have that nearly as good of performance as, say, an auto loan. Most of what makes up secured consumer loans for credits are auto loans. And so there is a real distinction in the difference in risk profiles there. And so we agreed with the commenters and we made that adjustment. And so what you see here is secured consumer loans, 19% of assets. The unsecured is much smaller than that. It's not nearly as high as 19% of assets. So while we did make that distinction, the credits are by and large are still benefiting from that distinction with the lower risk weight on secured consumer loans. We also, it wasn't just a theoretical argument that, hey, collateral. We actually looked at the loss history and the delinquency history on secured versus unsecured consumer, and it was much higher for unsecured loans than it is for secured.
Mary, you have a question?
Yes, very appreciative of this briefing, though, Larry. So I'll just limit it to one. On the risk weights, so we still have, and I haven't had a chance to look at all of them, but we still have a number of risk weights that are higher than what are for the banks. Maybe you talked about that today at the board meeting, but can you talk a little bit more about your rationale where we do have lower delinquency rates for credits, particularly mortgages, where I know they're higher in the proposal because I just looked. So if you could just talk a little bit more about the rationale on that.
The primary areas where we have higher risk weights, again, it relates to this red slice of the pie here. That's the portion of the balance sheet of complex credits where we'd have a more conservative risk weight. Almost all of those relate to the concentration risk framework, which FDIC and the other banking agencies don't have in their role. So that's really what's driving that. It's a very small portion of the assets in the complex credit unions. It's also a relatively small number of credit unions that trigger those thresholds. But we still feel strongly, as I had indicated when I discussed concentration risk, that we do need to pick up the outliers when it comes to concentration risk. And that's what it's doing. But a really small subset. The other area, there's two other areas where I can think of where we vary in a more conservative way from the other banking agencies. One is on unfunded, non-commercial loans, so off-balance sheet commitments. They're not actual balance sheet items, they're off-balance sheet items. We have we don't have a higher risk weight, we have a slightly higher credit conversion factor. So we have to do a credit conversion factor on off-balance sheet before you risk weight it. We have a slightly higher for non-commercial unfunded commitments, but it matches Basel. And so we thought that would make sense, facilitate credit unions managing those accounts, and they do tend to come on the balance sheet relatively quickly. But it's still a relatively small portion of the total assets and the total exposure in complex credit unions. The other one is in non-current or delinquent junior lien residential real estate loans. And in order to maintain the consistency of the risk weights, we went with 150, whereas FDIC weights them 100. So for some reason, and we don't really know why, the other banking agencies risk weight all junior lien residential at 100, and they don't make the delinquency distinction, but they do on all the other loans. So we thought it made more sense in our construct to use it at 150 to be consistent across how we treat current versus not current. And it's really a very, very small percentage of complex trading assets, less than 1/10 of 1%.
Another question? Right there.
Thank you for the briefing. Just while it's on our mind, could you, I know you covered it, but if you could walk through it again, how you're defining commercial versus business loans, I guess for 723 purposes.
So that's this slide. I'll do my best to try again at that. Congress in 1998, with passage of the Credit Union Membership Access Act, modified the Federal Credit Act to put a cap on member business loans. What it defined, Congress defined as member business loans, limited it to for credits that didn't have a low income designation or didn't have an exception or exemption provided for in the statute. And so it defined what it thought a member business, what Congress wanted to be a member business loan for purposes of measuring against that cap in the statute. And so we just implement that definition in Part 723. So Part 723 is really largely coming from the Act in that sense. Specifically, Congress defined a 1 to 4 family non-owner occupied residential real estate loan, non-owner occupied, as a business loan, member business loan, provided it's over $50,000 in assets. There's a categorical floor at $50,000, right? Banks, for the banking agencies, they risk weight those as residential real estate loans, not as business loans or commercial loans. And we think for a risk weighting standpoint, it makes more sense to treat them as residential real estate because that's the nature of the collateral than it does as a business loan. And so that's one distinction we're making. Another distinction we're making is a vehicle that's generally manufactured for personal use but not used for fare paying purposes or part of the fleet. So a farmer goes out and buys a pickup truck. You know, some of those pickup trucks are pretty big and they cost a lot of money. And they use it on the farm, you know, throw the tools in the back. But it's really a pickup truck. It's not a commercial vehicle. It's not part of a fleet. So we'll risk weight those as a secured consumer loan, not as a commercial loan. But provided they're above $50,000, they would still be defined in the law as an NBL and subject to the NBL cap. And then that's the difference in the cap. While for purposes of complying with the cap, the law exempts NBLs with balances less than $50,000. We don't think that makes sense from a risk weight standpoint because, again, a $50,500 loan with the same exact business purpose and collateral, a pizza oven or what have you, and $49,500, it's still going to perform as a commercial loan and therefore should be risk weighted accordingly, respective of balance. So it would be exempted from the NBL definition below $50,000, but it would be included in the commercial loan definition for risk weighting purposes under this proposal. And then finally, we also carve out and give a lower risk weight treatment to contractual compensating balances associated with a commercial loan and government guarantees associated with a commercial loan. So if you have a $100,000 loan, $20,000 is guaranteed by the government, $20,000 gets a lower risk weight, the other $80,000 gets the commercial loan risk weight. Is that it?
Thank you very much. Another question? Looks like we're good.
Great. Well, thank you for your time.
Yeah, thank you.